And the idea of pre-seed in the US and Africa is not the same. So pre-seed here means that you have traction. Over there, it means that you're selling a story, a narrative about the attractiveness of the market.
In psychology, they say the best predictor of future performance is past performance. So the best way you can, one of the best ways you can know how an investor has added value is will add value to is probably by asking those that have added value to how they did that.
Early stage startup, just conscious of the people in the room, is that you're better off getting a no money deal from an investor in Africa. If an investor is talking to you and they don't ask you what's your top three problems currently, I don't think that's really a serious investor.
At the end of the day, your investors are people too as well. And what that essentially means is they are not charity, they are in it for the commercial outcome. A strong indication for the quality of an opportunity can psychologically the investors use is as a proxy is the quality and number of fellow investors in the round.
In your experience, do you find that founders, I guess we'll start with Cholumide, do you find that founders, like they ask questions about the investors before they go ahead to invest? Or is it something that they just, before they go ahead to accept a deal, or do they just like, oh, someone has indicated interest in investing in my startup, and then they just go full on?
Ideally, you'd want founders to take time out to be diligent in the assessment of investors and kind of be picky. But the challenge is there are more founders and more startups generally than there are investors, and there are a lot more people interested in getting money from the investors than the money that is available for investors to give out in the first place. So founders don't always have the privilege of choosing. That being said, you can also be intentional with your approach, the type of investors you reach out to in the first place. And you can also be intentional about the partners you choose to work with within an investment company. So typically, most funds would have probably 2 to 3 partners. Um, so during the process at which you are trying to work with them, due diligence, they're trying to explore the opportunity. You can also use that as a time to, which partner, are you more, do you feel more connected to? Do you feel like you can work best with? And that can actually make a difference. Choosing the right set of partners, even within a company to work with. So, yeah.
That's point to make here, because sometimes looking from the outside, um, it's just more about picking the right investment firm rather than partners, or and then you kind of discard or disregard individuals who are in that firm. We'll come back to that, but I want to hear from you, Ayobami.
Just so what I think is that in we don't operate in, let's say, an efficient market, right? And it's very hard to find founders that are very much early stage. Get investors that are crazy about them. One, if you're not building proprietary tech, or you're not really, if traction is not really on your side, right? It's very hard that you find that you have the luxury of choosing what investor you want, or even just having that upper hand to push back on some certain terms, right? Because, and we know this because there are a lot of startups, there are very few funds that you can go to and they'll be willing to open their checkbook to you. So it's not just, and just from my experience working in VC, it's not enough for me to identify a company that is promising. Is that I must get a good chunk of that company. I must negotiate to a good chunk. And one thing I realize is that founders actually don't even take out the time to even negotiate at all. Maybe it's because from a scarcity mindset. Of course, there is the actual fact of scarcity, and then there is the side of fear from the side of the founders. It's really a two-way relationship. When we invest in you, we hope that you can return our fund, and if we're push the conversation to the point where we say, oh, we want to invest in you, it means we see something, right? No investor is going to come to you to due diligence or term sheets without thinking that there is something. But most founders don't realize that. Up until now, it works for us. It continues to work. But I've been on the side of a deal where we were begging for allocation in a particular startup, right? And those are the dynamics that founders don't really realize. And I hope that we can really delve into these issues. That's not ChatGPT to speak, by the way. It's just that we can really deep dive and then, dissect how these things show up and how to, gain like some upper hand like going forward.
Okay, so important disclaimer there before someone comes for you. All right, so a lot of the time these conversations will like start after the first pitch meeting, but a pitch meeting is ideally a good way to get a feel for how an investor is thinking about your business or about your sector, but you may not always have a long time to spend with them. So beyond that initial pitch meeting, what are some ways that a founder can get a sense of how an investor is thinking? Like to a very high degree of accuracy, how can they get a sense of that investor's thought?
I think that getting a sense of how an investor thinks goes way before the pitch meeting, right? You find out that a lot of founders are pitching to investors that are not really a fit for what you're trying to do. And it's not even about just the investors themselves. It's really about how you think about the capital structure of your business, right? If you come to me, there are some businesses that really don't need to. Okay, let's take it two steps back. Because of the way Nigeria is structured and the capital structure of our ecosystem, there is no we've not reached the maturity where a lot of companies that should have friend and family rounds have all of those rounds before actually coming to an institution, right? So you find out that companies that are premature in terms of their traction come to, and the idea of pre-seed in the US and Africa is not the same. So pre-seed here means that you have traction. Over there, it means you're selling a story, a narrative about the attractiveness of the market. If you're coming to me to say you're a pre-seed startup, I expect you to have like some traction like under your belt. So in terms of your company, I think it goes by looking at what kind of investor is actually a fit. Maybe you should not be talking to a VC in the first place. Maybe you should be looking at what is the best accelerator program or what's the best grants program you should be doing. But if you then decide that the next thing you want to do is come to a VC investor, you should take out time to please understand their investment thesis. An investment thesis outlines like how an investor thinks about the market, like what they want to invest in. You don't go to a pitch meeting and is at the pitch meeting you now realize that the investor does not invest in your sector, or they don't invest in your market or something like that. So typically, investor websites, they have like this thesis. Try to go through it. Try to look at what they've invested in prior. It's often a marker that they are open to this kind of sector. And so I'll just leave it there. So Olumide can maybe just buttress or just add color.
Yeah, I think you're quite exhaustive. The only thing I would say is, in terms of knowing how best, at least get going into it, you can always just speak to their existing portfolio companies, companies or funds generally. They have their websites. They're always proud about disclosing who the companies they've invested in are. And as a founder, fellow founders are also always willing to speak, and they can generally give you insight of what it's like working directly with the investor, what their experience has been, and from there you can even get a better context if the company, the fund is a fit for you, or perhaps the way they work or how they approach portfolio operations management, value creation, if it's a fit for you. So I guess that was probably the only additional piece I would add to that.
Okay. So a lot of founders approach investors just because of capital, but we talk about investors being able to add value beyond capital, right? How can I assess what value you bring to the table as an investor, apart from the capital?
Well, the first place to start is, again, asking questions. If you speak with the best way, I guess in psychology, they say the best predictor of future performance is past performance. So the best way you can, one of the best ways you can know how an investor has added value is will add value to is probably by asking those they've added value to how they did that. So speak to their portfolio companies. I don't know any fund that is shy of incoming or potential founders speaking to their already existing companies. They're always happy. They would even make those introductions directly to you if you don't have the network already. So speak to them. Then the other alternative or addition to that is just ask direct questions during the investment process. Like quite explicitly, how will you add value to me? This is the areas of need. Of course, I need financing, but there are also pieces I need. Do I need support on hiring? Do I need support on licensing, regulation? Is it market expansion, go-to-market strategy? You can always be explicit and ask about it from investors and ask how they've demonstrated those skill sets or those value add to any of their portfolio companies in the past. Yeah, I guess that those are the two most effective strategies I know I can think of right now.
Okay. So, do you want to add anything to that? Okay.
So reverse due diligence is good, talking to founders, but we need to be conscious that I think in our ecosystem, actually, we still have the problem of access, right? Talking to this is not we still have a situation where 9 years into the maturity of our ecosystem, we still report headlines like XXX raised that undisclosed funding. So the willingness to really share with you, coming to say, oh, what's your experience with this investor and all that? I mean, it's good, it's fine, but maybe they won't offer like that really in-depth stuff around, oh, how does this investor actually operate and stuff like that. So I think from just stepping back, just the things you look at, maybe they have a platform team and stuff like that. All those things are good. But for early stage startup, just conscious of the people in the room is that you're better off getting a no money deal from an investor in Africa. And then they can actually show that they have value add during the time you're doing due diligence. I realize that most people just come and they say all they need is money, right? If an investor is talking to you and they don't ask you what's your top 3 problems currently, I don't think that's really a serious investor, right? Because they will not just because they care about the money they are giving you. And one of the ways that you can preempt that conversation is just to say, oh, in as much as we want your money, it's like these are the top 3 problems you have. And we've had cases where, some of the most successful seed stage funds are the ones that open access to, regulatory. They have regulatory network. I think somebody in Olumide's fund was once a minister of, technology. So they're able to open up those networks. As a founder, are you self-aware to know the problems that you have beyond cash? Can you bring those up during the conversation you're having with them? Chances are that what we do, right, at Endeavor is because we work with very late stage companies. So when we are talking to them and say, what 3 problems do you have? We know if we cannot give you money, we'll then direct you to somebody that can help out with that challenge. So those are ways that a company that has capacity to actually help you is don't always just go asking for money. Because sometimes one thing we have realized is that if they give you the money, okay, does money open the access to CBN? Our economy and the market is still very much unstructured that you need access capital is as tangible as monetary capital, right? I'm not saying you don't need money. You do need money, but like all those things around, strategic access, can they connect you with somebody? Do they have internal capacity to help you structure a deal or just attract all those other kind of things? Is things that you should bring up right when you're talking so they know that the field of play is not just this person is not just asking for money. The field of play is like larger and they want like value to be added to the company upfront. Right.
All right. So earlier you talked about like shifting the balance of power and making it equal because an investor has something they want, they need to return their fund. The founder, on the other hand, needs to grow his business or take it to the next level. How do you create a scenario? I don't want to use fear of missing out because I feel like it's a bad thing. But how do you create enough excitement around your startup such that investors are keen? And we are looking at what we have in the room, but also people who may be watching much later, so we can speak to both early stage founders and maybe people who are like 2, 3 years into the journey.
I think the just simple answer, the most practical answer is to delay fundraising as possible, right? And that's why I
Delay
said,
fundraising.
yeah, delay
Okay.
fundraising as possible. Let us come and knock, let us come and beg. I mean, that's the kind of things that excite us, right? When a company is growing and then we necessarily, if you're as capital efficient as possible, that's why the best way, people don't say this often, is like the best way to start a startup is really your personal savings, family and friends. If you can show traction, this is not I'm having like a very different opinion about the ecosystem as a whole. Reflecting from disbursing capital and then supporting startups for 5 years is like we do say we back early stage startup, but early stage startup is not really as early stage as you think. It's you need to show traction before, even for the day one accelerators and stuff like that, we look at traction. But is that what, even for idea stage accelerators and idea stage incubators, they ask you for things like, oh, MVP and all that. But if you're not a technical founder, you know that to actually get like your MVP towards a certain extent, if you are building like a SaaS product, you need to procure like technical this stuff and that. So one thing I've seen, and I'll give you an example. Team Apt, for example, did not raise conventional funding for a long time. The folks that come out to say, oh, they are raising like a big round, like Juicy Way, for example, they've been in stealth for a long time. There've been a lot of, growth, that inorganic growth, maybe through acquisitions and stuff like that, that be happening like behind the scenes and stuff like that. So when they came out to say, oh, we have like a billion, we've processed a billion, it's all those kind of deals that investors really fight for, and then you have more leverage. Or if you are building something that rides on the current um
Yeah.
yeah, the current wave, you say something like you're building AI for people are slapping AI on anything now. You just say maybe you're doing payday loan, you say you're now doing AI that can do human resource management and all those kind of things. It's because we are looking for what's going to 10x our fund. And the truth is, we don't know, but we don't want to miss out. And the other hand, if you are willing to build like a real business, I would say delay fundraising for as much as possible. Try to get like those traction, so that when you're talking to an investor, it's a concrete conversation. Even for those that have traction currently, the market has shifted so much that we are the kind of terms we are demanding of founders are very much conservative. So the earlier you are in that track, I mean, it's very hard for you to demand certain things. I don't know what trends Olumide is also saying.
No, I think your answer again is exhaustive. The only thing I'll probably add is, as it relates to getting investor interest, it can be helpful if there is the knowledge of you came through a trusted source, someone they know, someone that is reputable in their mind, and someone that vouch highly for you. Sometimes the difference between two startups is that an investor came into the conversation with a higher expectation versus another conversation, same startup, doing similar things, probably similar traction, but one came recommended highly from someone they know, trust, and they rate highly, and from that, that excitement follows through how they assess what they are seeing, and the investors are humans as well. So if I'm coming into a conversation with you and I'm already excited about speaking with you, there's a higher tendency that excitement will continue, versus maybe a cold email, an unknown source, a deal came through somewhere, and I just see it, I'm like, this person's not doing anything different. But the same person that is not doing anything different, if it comes through a strong recommendation, I will look at it in a different light. So I guess that's the only addition I would add to that in terms of drumming up excitement.
Okay.
And a way to, because people will now ask, how do I get to know these big people? Like, you have just shifted the goalpost. It's supposed to be build something, build it well, and stuff like that. I think at the earlier stages, founders should try to get advisors. That's just one way to also just short circuit the whole thing. Because if you're, what would it take you to, for you to get like somebody to make an intro for you and stuff like that, if you don't come from a place or just a background where there's like plenty of social capital, it pays for you to speak with top level, and it could be just C-suite executives, right? Just pitch what you're doing to them, tell them to come on board as advisors. And what we found out from our experience at Endeavor is that 80 out of 100 times, like these people are willing to just associate with the next generation and all those kind of stuff. We see that happen in our portfolio a lot. Like folks that have, in fact, retired from their career, like on an international scene, I just say, "Oh, sir, do you have some time to talk to this founder?" Because that's what I basically do, like for a living. Is like, "Do you have some time to talk to this founder?" And they're like, "Sure." And I'm like, in my own head, I built like this mental barrier that this person is actually inaccessible, right? So from day one, if you're building a fintech, try to get, let's say, somebody that is just in the banking system to be an advisor. It doesn't have to be something big. Someone you just report your progress to. As time goes on, maybe they will allow you, associate their name on your deck and stuff like that. We've taken some calls because we saw some names on the deck as advisors and stuff like that. So you don't really need to come from a lot, but you can try and just connect. This is just one strategy I know that has worked, proven and tested. Getting advisors that are relevant in your field, tell them about what you're doing, try to build a relationship with them, be accountable to them, send them regular updates, and who knows, one day they'll just say, "Oh, I know someone who is doing this, talk to this person." It's really, that's how it works, really, for real.
Okay. So, I mean, two things stand out from your response. One is basically building relationships before you need them. Something I've discovered, that's to your point about people being willing to help, is reaching out to someone you do not know out of the views, and the person is like really keen to get on a call with you to explain something. Because there's always that mental barrier. I don't know this person from anywhere. There's really no reason for him to respond to me, but the person responds, and you're a bit surprised. So I guess take more shots. And then the other part that you spoke about, which is like super important. Unfortunately, I've lost my train of thought. Okay, yeah, I think I'll probably remember it at some point. But yeah, let's move to the next question, which is around identifying red flags. So you're speaking to an investor, you've spoken to portfolio companies, right? You have looked at their website, you know a lot of things. But just the same way we have like really shitty founders, I believe we also have shitty investors who they have the money, they're in a good firm, but they're just shitty individuals. So what kind of red flags should I be looking out for when interacting with a potential investor?
Yeah, that's a very interesting question. I think the biggest red flags typically fall into two categories. There can be more from time to time, but typically two categories. The first is in communication. So again, throughout the process where you are engaging with the fund and they're trying to assess you for investment, you can observe patterns. You can see how they interact with you. Like, are they sending you messages at 3 a.m. and asking you to respond before 5 a.m.? Like, are they the ways they are positioning themselves when you meet them in person, or how you see them, how they engage and interact with other people? So communication is probably, you want to take an intentional look of that when you're engaging with investors. How do they communicate and how do they engage with you generally? Are you a pre-seed stage startup and they are looking down on your opportunities simply because it's pre-seed and they say, oh, they are late stage investors, but you can observe trends and just see how people interact. The second layer to that is the intention. So you always want to be on the lookout for, does this person also, this fund, it can be the person, the partner, it can be the fund, do they have my interest at as well? And the best way you typically see that is from the way they negotiate, especially when it comes to term sheets. As investors, we have to negotiate favorably for ourselves. But there's a way you can negotiate favorably for yourself without necessarily, for lack of a better term, fucking me up, right? So look at how they negotiate, how they discuss terms. Sometimes you can actually have begin discussing terms even before you get to term sheet stage. Like, what are they thinking about having a board seat? What are they thinking about um, uh, ownership, right? For example, what are the thoughts about giving you an ESOP or creating an allocation so that perhaps as founders you can recoup some shares back later down the years? So again, investors will fight for themselves, but again, there is a way you can put yourself in a good position without necessarily putting the founder in a negative or worse off position because you want to invest. So again, just to wrap up, those are the two things, two areas where I think founders can spot early red flags. The way the fund or the partner, the way they engage and they communicate, and as well the way they negotiate terms or just structure of the deal.
All right, Ayobami.
Yeah, I think it's very simple. They are predatory funds, and they are just funds that are there, and then they are good funds, right? Most funds, we pitch ourselves as good funds, but we're just there. And some people go out of their way to be predatory. Is from past deals, if you realize that this person, you're a pre-seed company, and they ask you for anything above 30%, 40% of your company, just know that you are well on your way to being an employee when you raise your seed series A round, because the dilution will hit you like you won't. It's unbelievable. So even in the ways that they negotiate it, and because most people that try to come for fundraisers, and I see this a lot with what Olumide said, is probably this is their first company. We know what to sneak into a term sheet. We know what to, and then you don't have the luxury of hiring a lawyer that can maybe dissect these things. If you look at an investor will optimize for two things: control and economics. Red flag from an economic standpoint, if we say we'll give you 5 million naira for 20% of your company, and then we're beating it down. We're actually going back to back with you based on what you presented to us. But we're now, the way we are doing it does not reflect, it gives you very little room for growth. That's a red flag, because if you think about it, a VC firm relationship is between 7 years to 10 years. So it's like you're really getting in bed with someone. Like, and the earliest every investor money you get is like it's a discount on the future value if your company continues to deliver value or remain profitable. Just even if there's any upside, it's like you're going on a journey with me. Everything Olu said about just investor personality, very accurate. If I tell you I want to do due diligence and I don't get back to you in 4 weeks, I come, I raise your hopes again, I don't get back in 4 weeks. Probably I don't have funds to disburse. That's what it may mean. Maybe I don't have dry powder, and I just keep telling you I will put you through this round of diligence. Many people have those experiences. Is you need to also look, does this fund, do they have money to actually give, or do they just want to waste your time? And if they're wasting your time, there are people you probably don't want to sign a term sheet with. Why? Because there are times where we've seen where a founder will raise money from a fund, they sign the term sheet, but disbursing those funds, it's another story, right? So you don't want to put yourself in that kind of situation. Is very early on, and the way you know is very simple. Just look at the fund, just check. You can just check online, take about Condia, Tech Point, everybody they report on these things very well. It's like, when was their last fundraise? If the last fundraise was like more than 4 years ago, just know that probably there is no like significant enthusiasm to invest in new companies. The money they have maybe is for follow-on rounds and stuff like that. If they just raise a new fund, the more you know that, okay, these guys have money, right? That's one. And then on the economic side of things, don't give away too much of your company, no matter how early you are. Try and find other ways. That's why you're CEO. Find other ways to survive. Keep it lean until you have like some level of traction. Because if you start out an investment journey of giving out 40%, it really distorts um, things. And I think there are other red flags that I don't know if, and it's on a case by case basis. So I wouldn't want to fall into the trap of like name dropping any particular fund or stuff, but also put your ears on the ground. Like Olu said, speak to other founders. Like these ones that invested in you, how long did it take before they give you money? Is it that they'll tell you they'll give you money today and then 2 weeks down the line they'll say, oh, they'll not tie it to milestones and the milestones are arbitrary. It's the problem that founders face that I think is not so good. It's not too good in how we behave even as investors in Africa.
Okay. So, like I said earlier, we will be taking questions. If you have any questions, you can just note them down and we will start taking them in maybe a few minutes. You talked earlier about founders getting into these conversations and not even negotiating at all. How can I negotiate? So, first of all, a lot of technical people, they can't even build relationships in the first place. So, negotiation is like a whole different ball game. So, how can I build my negotiating muscles?
Yeah, negotiation begins with every every term that is given to you. Look at it look at it again. It's a lot of money. Like imagine you are starting a business and someone comes and says, "Oh, I'll give you $100,000." Right? But we'll discuss the terms later and stuff like that. Like just the idea of like say you give someone $100,000 is already alluring, and I've found myself in such position like negotiating a deal with somebody because this company was very early on. This founder very conservative, but we could see that this company is going to grow. So we for lack of a better word, wanted to just take advantage of that knowledge gap, right? So we would say things like, oh, we're going to give you up to like how much do you need to actually move this business from point A to point B? Is the thing is you can't negotiate if you don't know that number. If the number that will take you from where you currently are to point B, let's say you need to get to 100,000 in revenue, right? Or you need to push your product out and just get to, let's say, a million users will get you 500K in ARR or whatever is unique to your business model. What we realize is most founders don't know that particular number. You come to us, you think we're giving you big money, but when you now actually go and implement or you try to put that figure to work, you realize you need to come back for another round or come back for start. So it's really you can't negotiate if you don't know the numbers. Your negotiation is only as impactful as the intelligence you have about the business and about the numbers. So as much as possible, we advise folks that always have a counterparty, like always have folks that you're talking to that are advising you on that particular transaction, especially if you're a first-time founder or even the second time. No, if you are raising for the first time or even raising for subsequent round, because if you come first say no or never make a decision right there and there. Always say things like you go back to think about it. It may seem very simple, but like a lot of founders, because of the scarcity in the ecosystem, if anybody throws 50K at someone, they're more likely to take it. And once you start implementing, you realize 50K would not even take you to the next milestone. So it's really say you're going to take time to think about it. An investor that tells you you need to make a decision in 3 days or 5 days or 1 week, that's not the that's a red flag, right? It's like we're seeing, and this just I don't know, it's not a trade secret, but maybe we are seeing something that you're not seeing, and we want to quickly take advantage of it before table turns, because there was a particular case where I was on a deal, and the terms actually changed in 2 weeks because the founder hesitated. So it was 7.5. The founder, we went back and forth. We're not really sold on it. We knew there was opportunity, but we're not sold on it. Then we heard word that, you know, some other VC firm was trying to, invest. That raises like the competitiveness of the deal. And then the founder, I don't know, he spoke to somebody. I don't know. It really be your guys that will be running your deals. And then he spoke to the guy and then came back and said, oh, they wanted to do the deal at 2x the valuation that they gave us. And guess what? We did it. But they've gotten that deal 50% cheaper. Right? So there's a power of if founders just need to know that if you guys are not here, we will not return the fund. And we cannot sit on money, we cannot return capital. It's a sign of failure. So when we come to you and we reach that point where we say, okay, we want to do due diligence, we see that there's something here, we start negotiating terms, you also find your voice. Maybe that's the time for you to find your voice. Don't be combative, don't be adversarial, of course, because we're going to be in bed for a long time. But don't just, it's not a one-way street. If you don't know what to say, just say, take a pause and say, oh, we'll get back to you. I don't like, Olu would have more stuff to say around like these things because they do bigger deals and
Thank you. So, as regards negotiation, the most powerful toolkit in the bag is typically what you've already cited, which is having someone else interested in the round. And again, that's just because at the end of the day, your investors are people too as well, and they all have one goal. Um, they want to, as a fund VC, you only have one goal pretty much. You want to return, or not just return, but you want to return capital and get a lot of higher returns to your investors, ROI, and everything in between. Um, and what that essentially means is they are not charity; they are in it for the commercial outcome. If you A strong indication for the quality of an opportunity can psychologically the investors use is as a proxy is the quality and number of fellow investors in the round. So sometimes you can have more people in the round and it doesn't mean anything just because they are not necessarily quality investors. Um, but typically, I guess quality probably over quantity, all things being equal. But the higher the quality of your existing cap table, as well as the higher the quality of investors are interested in that round, all things considered, the more willing a fund will be to negotiate with you. It's also always useful to work with experts. So there are lawyers. Unfortunately, a lot of lawyers don't necessarily have startup focus, but there are a few startup law firms around. Or if you're using another law firm, just make sure you're working with someone in there that has a good startup experience so they can point you to the predatory terms or the things that are generally not favorable. And ideally, in as much as you're negotiating common sense, which is the terms XYZ investor is proposing to me, it's not beneficial to me. Ideally, they'll be open to that conversation because what you're trying to do is just trying to find a balance. Um, Investors are typically not very hostile. They're typically not very hostile at negotiation, unfortunately, and that may come as a surprise. And that's because at the point of investment, an investor has probably done 2 to 3 months of work, diligence, and they've done a lot of work to decide, okay, this is a good fit for us. So as at that point, they actually want you. So you're no longer at the phase where you are, again, you should still be humble and all of that, still approach it with the right mindset. But generally, they actually do want you. If you're at the point where you're negotiating terms, they've decided they want you already. So you have some negotiating power. You have the room to say, hey, what you're proposing, I don't want. And I guess knowledge is power, right? If you work with experts and people who know the right things and they can check the terms and the proposition, that will put you in a better position. But if you can also drum up interest from other investors, particularly higher quality investors, you're putting yourself in a really good position. Investors would negotiate any time if it's rational and if it makes sense for them.
Okay, so I think we've touched on quite a number of really important things. Maybe just do a little recap. So one is like delay fundraising as much as possible. I think that's like very solid advice because probably you want to say something?
Yeah, there's good context to delaying fundraising, right? Because in the end as well, the definition of a startup is a fast-growing early-stage business. You are not necessarily a startup 8 years into your journey and you're raising a seed. You like maybe if you're raising your Series B, that's possible. But you want to gather as much traction as quickly as you can reasonably manage. So delay fundraising up to the point where you can get the maximum traction you can possibly, because that would improve your leverage. But don't delay fundraising for the sake of delaying fundraising. If you're delaying fundraising but you're not going, or here is your case, unfortunately. So I've seen plenty people, come around a 5-year-old business. They're making X number. I'm not going to give you numbers. They're making X number, and they're like, okay, good for you, but like you've been at this for 5 years. There's no the lingua in investment. There's no traction to show for it. So you always want to balance traction. I guess the point is you want to go to the market, i.e., you want to begin your fundraising journey when you have the maximum traction possible you can get pre-fundraising. That's the critical edge.
Okay, so I think it's good to modify that advice. Do you want to say something? Yeah.
Just to add more color to that is while maybe you cannot say exact numbers is if you do realize that your company, the growth rate of your company is crazy and is consistent. You are growing, let's say, 100% month on month. That's actually very insane. But if you're growing 100% month on month, 200% month on month, it's like a strong indication that people want this, right? Maybe that's like a you can take the early route to having like a venture conversation and stuff like that. But if you're not if you're not growing at that pace, you're not cash flow positive, but you're delaying it. I mean, one thing I've said also is it's not a venture capital conversation, and that's the reality that most people coming into starting startups currently should know. It's like the world where we knew startups, as where money was flowing, there was like big funders. That period has passed. Like the folks who even made their money in tech are starting accelerators that are capping all the folks that are coming in at $1 million. So what does that say to you is, and one of the things I would say to what he asked was, I do think that in your earliest days, even when you're having that kind of traction, the only people you should give a good discount or a good deal are angel investors. And angel investors, for example, I'll tell you how many deals have happened in fintech. If you come to me today and you say you have a fintech application and stuff like that, there is almost every reason for me to be hesitant. But if you say you have, let's say, a fintech application in payments infrastructure, and I see that Ezra is an angel investor, right? We use these things, these markers as proxy. I'm not a sector expert in fintech. You don't have sector specialist fund in Africa. Not you don't have a lot. So most are generally some pick maybe B2B and stuff like that. Even at that, in the sub categories, you don't have like all those sector specific funds. So if you say you are building a fintech and then you get an angel investor like Ezra, some folks in health tech, there's actually an active investor, an angel investor that actually invests just solely in health tech. So if we see those people on your cap table, you've not raised any institutional funding, but kind of it gives us like confidence to explore a conversation with you, right? And it also goes all the way all through your fundraising journey. Like you said, some people are 2 to 3 years into their fundraising round. It's a different conversation. If you raised money from, let's say, an early stage fund, their willingness to do a follow-on funding is what signals if we should actually speak to you. If the current investors are not willing to double down, should I be the one to come and hold the bag? That's the kind of things that we think about, right? So even as you plan, many people plan their startup from a product perspective. They don't plan the financing um, angle at all. So when I say when he says you need social network, I say go and get advisors that are corporate. Chances are that as you become accountable to those people, they are seeing the way you're growing really fast. You are reporting it, you are telling the story really well in terms of like the growth rate. They would say, oh, I want to be a part of this. They will invest. Once they invest, I will say, oh, this person is a sector leader. There is something Abubakar Suleiman knows about finance and tech, fintech, financial services that I would not know, even as an analyst that has been in the VC space. I would want to I want to check what is there, right? And the funny thing is, Abubakar, Suleiman, Ezra, and all those guys, maybe they gave you just a 5K check, but it's a check to just set you up on a launch pad. So I feel like most people should actually try to explore those options. Take your time because there's a lot of value they add beyond just the small check they give. It's like once we see those things, it fuels confidence, investor confidence. And that's why if you look at the fundraise of the guy that raised even $3 million, if you look at the names of there were names of like angel investors that were there, were like, oh, X person, Andrea Lee was in the round of juice and stuff like that. I'm like, this is somebody that's been a CEO of Africa Finance Corporation, like, very well active in the capital community. They were maybe those people are even the ones that make introductions to the early stage fund. The way Africa VC works is very much unstructured. It's really like a ladder. The angel investors are the ones that sit on the investment committee of the pre-seed funds. So it's more like, okay, give this guy money. And I've found cases where we found like angel investors telling even subnational grants to give grants to their company. It's not like you don't know how to pitch, my brother. It's just maybe it's just is a ladder. It's maybe it may not be ideal, but that's the reality we find ourselves in. So don't try to jump many steps to go to institutional funding, even as your company is growing. I'm not saying delay fundraising. When I say delay fundraising, maybe don't come to institutions first. Go to people that they can signal that, oh, just their presence on the cap table is like, this guy knows something that I don't know. Let's look at it. They will introduce you to the pre-seed fund. The pre-seed funds actually serve as a feeder to bigger funds. If you notice, there was a time when there were not really a lot of funds. It was folks that got into Future Africa and stuff like that that you really see getting into YC, or folks that, let's say, the bonds in the ecosystem investing, that they'll get into YC. It's basically that was the track. It's like they made introductions on your behalf to YC and stuff like that. So it's really try to grow fast, focus on your month-to-month growth. Maybe not focus on the bottom line at the initial level. As you're growing fast, make connections with advisors, try to secure angel checks, no matter how small it is. Like they signal a lot for your deal, like down the line. Yeah, just on that point, Olu, please, you like have something to say because I think this is very important. It's stuff we don't say. We just see maybe an Ezra on your fintech. We see maybe a renowned doctor on your health tech, and they were like, maybe there's something to look at here. And I don't know, maybe you want to can buttress with some of the experiences. Yeah.
Of course.
Yeah, I probably will not belabor the negotiation point, but I would say generally, one of the most effective things you could do to, generally garner interest from investors is improve your storytelling, communication storytelling, essentially, because again, at the end of the day, your investors are people, and if you communicate and if you express something that drives that gives a strong indication of the future. That is what investors are looking for. They are looking for a great future that will result in greater exit and outcome for them, for themselves, and of course for you as a founder. So I've seen two businesses doing the same thing, similar level of traction. You join a call for one, and you join the call for the other, and one just pitches better. They explain what they're doing better. They communicate the vision of where they are aiming to get to better. It doesn't necessarily mean they have the better product right now. Sometimes they may even be a little behind on the traction, but the future that they are painting and where they are heading to and where they want to get to is much clearer and is much more convincing. So if there's a soft skill that probably has the greatest impact on the outcome of your fundraising, it's just your ability to pitch. Some of the startups have raised from a lot of the international VCs. It's not necessarily because they have better underlying businesses than their peers here. They are just better storytellers. And those international investors, they are moved by that. And again, in the end, I'm a person, you're a person. You like a good story. Tell a good story, communicate clearly, share a brighter vision, and all things considered, you may not be able to convince a fund that is not investing in your sector, but surely, I'm sure there are one or two investors that are midway through and they are in between. Those investors, those are people you can increasingly convince, and you'll get a yes from, and you probably just overall get better value from that, even in the way you run your business and the way you communicate to your team generally.
Okay. All right. I think we've covered like a lot of ground, and this should be really helpful for anyone who is planning to fundraise. So we talked about traction, and unfortunately, it's not like there's a website you'd go to and you find traction. So I mean, someone should build it a bit. All right. So something I've seen a few founders do that helps is like ask around. So he would know what the traction for like maybe fintechs, a pre-seed traction would look like, right? Someone who invests in health tech could probably know. Founders as well who have raised, you could ask what traction they. So unfortunately, some people don't answer you, but it's always helpful to just ask. Just wanted to throw that in for the traction bit. Every other thing, you'd have to hope that you're on the money when you are pitching. So we'll take questions now. We have some time, so we take like, let's see, we'll take about 4 or 5 questions. So let's start with you, Joseph. Sorry. Okay. Sorry, can I get one mic, please?
Okay, thank you. My name is Joseph Olaoluwa. I'm a person. I'm part of the ecosystem. Sorry. So I have
good to meet you.
You said?
Good to meet you.
You met before. I have an hypothetical situation, right? I don't want to name drop, but just trying to see what both of you think, right? There's a founder, female founder, done this. She's in the agri-grocery sector. She's done it for 4+ years. She claims she's profitable. I've not seen the numbers, but she claims she's profitable. She has good GMV. Her situation has been trying to secure an investment, which is like around 500K, for some time, right? And some of our complaints, I cannot say loudly, but like investors are not looking, female investors are not looking as well. I just wanted to get a kind of, I just want a hypothetical possible answer from your ends, based on this information I just presented, what the possibility of a fundraise could be for someone like her. That's one. Then 2, I wanted to ask, I think, Ayobami, you said something about if it's not a VC conversation, right? And, that's funny because we are here and we are hoping that the VC saves us from all this trouble by investing in our lives. And you're here telling us that this is not a VC conversation. Who will now bear the cat, or who will carry the bag? So both of you can answer to both of them. I just need a good answer. Thank you very much.
I'm trying to go first. Sorry, no one is coming to save you, unfortunately. That's the short answer. Again, the investors are there for a commercial purpose. They're not. They would help and support you because there's a consequence and there's a commercial outcome to that help and support. So it's not. There's impact investing. So there are those that would happily support you in a sense where they're doing it for the intention of support itself. So, in female founder, agribusiness, she can always explore that. And again, that's not to say anything is wrong with her business or to say she can't fundraise. There are many, she can probably point to 2 or 3 similar players doing similar things as her that are fundraised. So there's probably something to double check with her in terms of how she approaching her storytelling. And something to be curious about. You said earlier she has good GMV, profitable. That's nice, but what is good? What does good mean? Um, I find a lot of times that what founders define as good traction is not necessarily what an investor would qualify as that. And a simple exercise is just she's probably generating revenue in Naira. Divide that in USD, for example, and start with that. What has been her traction over the last 4 years as she's been operating? Investors would look at the dollar amount, unfortunately, not the Naira amount, and that's where they want to see growth. So again, maybe you divide that and she's still doing incredibly well. Um, then there will not be further questions, and we'll probably need to do a one-on-one deep dive to understand what the context there is. Just to say, investors typically they're investing for commercial reason, and if what you're building would generate them a commercial outcome, they will invest. Even at these times when people are saying, "Oh, ecosystem is down," all of that, if you're building a high quality business and an investor can see a rational, logical, high potential, probabilistic outcome, they will chase you. And investors are right now still just certain opportunities that they are chasing. So it's about being. Anyways, yeah, I think I've generally answered the question. There will be certain context that is unique to her, but she should have a curious look at the commercial vision that she's positioning. If it will generate uh, a high probabilistic outcome, an investor would have a look. Um, so the other question of who is coming to save who, I guess I already answered that as well. It's a commercial outcome business. Investors are looking for the highest quality startups they can invest in, all things being equal. Um, if you can position yourself as that, you would there's higher chances you would achieve fundraising success, all things being equal.
Yeah, thank you. So I was just trying to make mental note of what you said. I think when I said stuff around like maybe it's not a VC conversation, it's just around the fact that everybody that wants to start something currently, maybe because of what happened in 2021, right? We had like a lot of capital coming to the ecosystem and we're funding all kinds of business models that were true to the tech, true to the tech, the tech track, and then business models that were not really in the tech track, but like they would just say they have like maybe some tech tool that could have served as a process, could be helping them with their internal processes, and we would fund them, right? Because there was money. But now, like the funding tap has kind of freezed a bit, and I'm just encouraging founders to think through their business like from the lens of entrepreneurial finance, not just VC. It's something that applies all through. Probably the lady that you cited that runs like a business for 4 years, has good GMV and stuff like that. There's already a track record. It's profitable. There's GMV. It's profitable. There's a track record. Maybe that person needs to raise working capital. Probably they should explore venture debt, right? And because the business is kind of like it's consistent, all things being equal. What does the person want to raise money for? Is it to build technology to do those kind of things? And I'll give you an example. There was a founder I worked with, consulted for. She runs like a pharmacy business, brick and mortar, about four stores. Then she wanted to pivot into tech. What she did realistically was that she used the proceeds of the brick and mortar to build MVP for that tech. And what we now did was, because no investor is going to touch that because it's two different business models. The brick and mortar is P kind of stuff. This tech thing that we're trying to build, and not slap, but try to build telemedicine around and all those kind of great, nice sounding stuff, is tech. So what we did was, okay, the sweetest way we could just raise money was apply for the Africa Business Euros. And this person actually made like good step, getting like a lot of money from there. She has raised money from there, leveraging contact that she had. So we've proven that this person would not have gotten tech money. But it was a business that was very liquid. Anybody that is into the pharmacy space knows how much volume is there. So it's really like, is the business model compatible with the VC structure? It sucks, that we have tech businesses that are losing money, not really doing a lot, and then there are traditional businesses that you may even know someone that is doing crazy numbers. But can that business, a fund that does like, when if you do 2x on an investment, it's not a success for us. 2x on the valuation. What looks like success for us when we model everything, and we look at it on a business by business basis, is the way a fund works is, if we have 30 investments, power losses, maybe we're looking for the three that return the fund, but we invest with the mindset that every company is one of that three, that outlier. So we don't go in saying we want to balance the portfolio with safe bets right from the beginning. So that's why we will not see a fund go and invest in a pharmacy that has like plenty chains and stuff like that, because the 10x upside, like relative to the cost you have to put in, you are best suited for a venture debt where they'll give you 100 million, or let's say even $10 million. There's a reason why Landmark, they don't raise venture capital. It's a very liquid business. People come in, they go out. You can say that subscription. The people coming to the beach, you can build tech around it. But it's not really a tech business. Like, the business model is not compatible with the VC stuff. So the problem is, we pick every company we select with the mindset that they'll be part of those three outliers. 27, you may look at our portfolio and say, oh, 20 out of these 30, they are not even better than this woman that you mentioned, that the business is doing maybe 2x, great stuff and fun like that. But on the whole, I think thinking about your business from the entrepreneurial finance angle is, even tech businesses, as they begin to mature, they realize that equity is expensive. Then when they announce a big fundraise of, you say, 100 million, you hear that 40 million is equity, 60 million is debt. Tribe agree, just go and study um their their capital raise, the capital raise they have. So as founders, we just need to think, oh, what really is my business model, right? And I know that I'm talking to a lot of people in the room and even online, that what they are building is not the way when you start pitching it, I know it's not tech track. I know this is not a tech business. This does not fit in that archetype of that three companies that we're looking for. But you have good numbers, but you should you should just be real with let your business model dictate the kind of funding you go for. Maybe venture debt. There's loans. Loans are really exorbitant now. I wouldn't advise it, but like, there are different options to that. And I think the second question, or the first you asked, was really around. I think he has answered most about that. And then to the VC time, is just understand our perspective. When we are selecting individual companies, we are selecting with the mind that is one of those three. But a company that returns 2x is a failure for us, because if you return 2x, when you return 10x is when, okay, things start getting interesting. And if five companies return 10x out of 30 companies, it's fun maths. Like, they are looking at the maths every single time. Not every investment will return 10x. Some investment will return 41x, like a pay stack exit. But most, even within the tech portfolio, return somewhere between, um, it's a conservative number, but that's not the mindset we had when we were investing, and we would not now start balancing the portfolio. Otherwise, we become a PE firm, right? We are just better off raising 100 million, disbursing to businesses that we know that this one we can. If anything goes wrong, we can onboard the business, sell the assets, recoup investment and stuff like that. It's two different capital structure and environment. So as entrepreneurs in the post 2021 post zero interest policy program, is like, you need to think about your business. You need to consider all possible options, right? And don't sell your business cheaply. If you come to any investor now, and it's very interesting that investors that made their money from tech and are launching funds are giving founders very, very conservative valuation. Valuation that if somebody gave them when they were starting, there was no way they would have become unicorn or even unicorns, right? So you just need to stay alive long enough to have that leverage to fight. Like, when people wanted to invest in Team we were people were begging, right? To get into that is, maybe you need to. And again, to your point, the game is not over for the lady, right? 4 years in business. There are businesses that it was like Simfix did their first institutional funding, 4.5 million. There's always a second act. There could be a digital transformation, a turnaround. You can come and meet me. We'll talk about it, right? How you can go from brick and mortar to positioning yourself as, just move with the times. But I just think that it's two different business models, and the storytelling will not be from the perspective of, oh, we're profitable on something that's consistent. It's like we use this as a pilot. Now we want to go into this and stuff like that. And I really don't know if that person wants to put themselves under that headache, right? It's for it to be on a VC track, it means you want to return more than 10x in like in 10 years, in less than 10 years, right? In less than 10 years, like, is it really worth that stress? Because you have to get diluted a lot of time. So it's often like a much nuanced conversation than that. We are not perfect, but every single investment we pick it with the mind that is one of those three, and we don't try to balance the portfolio upfront. So I hope that answers it.
Yeah, I think we can still take a few questions. Emmanuel? Okay.
Hi, hello. Hi, Olumide. How are you? Hi. I wanted to ask about founders that are not the outliers. You're not part of the inner circle, right? I don't know Olumide's showing on bottom of my deck, right? I don't know top buzz names. I'm not part of the inner circle, right? So I don't have such leverages that you mentioned. I'm on the outside. If I'm not in the ecosystem, I'm looking in, right? I need 50K to 200K to survive, to look like what you want me to look like. And because I don't have those magic numbers, VCs are not even looking at what I'm looking at, right? So my question is, where do you find the angel investors, the incubators, accelerators, who can write you this 50K, 100? I will not destroy your company, not destroy, but will not basically give you really messed up deals that nobody will touch your term sheets because somebody has taken 35% equity stake as a venture studio for business development and they don't even give you capital, right? So, like, where do you find those people that can help you stay alive, help you build your product, help you get to PMF and, go to market and have some level of, and look like what investors are ready to invest in?
So the question is, how do you also? So, like I said, a good way to always short circuit things is engaging with someone that is already there. So yes, you say I'm not part of the inner circle. I don't know the right people, but access is somewhat democratized nowadays. It doesn't. You are one LinkedIn message away from speaking to I'm not a senior founder, for lack of a better term, or a potential advisor, or someone that is a connection to the inner circle. And in fact, you're one LinkedIn message away from speaking to some of the investors directly. So it's not necessarily totally out of your control. I guess somewhat, but you can always reach out to people. You are not part of the inner circle yet, but some of the people in the inner circle, everyone can probably acknowledge that they were not born in the inner circle. They worked their way into it from randomly reaching out to people or sometimes just being in service of other people. So what service, what value add can you provide to these people that were in the inner circle adjacent to it? And I guess if you provide enough sufficient value to someone, they will be able to, put a good word for you, all things considered. Well, it's probably a red flag if the first thing someone is asking you is the equity they will take in your business for helping you. I guess a general rule of thumb is always no advisor should practically be getting more than 1.5%, all things considered. But even that is probably too high. If someone has not added value, why are you giving them an equity? So even if you hypothetically want to give them an equity, it probably should be conditional on and conditional and post the delivery of that value, not pre. So that's how I would approach that. Reach out to people, add value to people, and in turn they'll be in a better position to, add value back to you and connect you to the inner circle. I would also say explore other funding alternatives. Grants, again, I guess grants may have a bad label from the maybe the commercial investors, but generally, if you're starting from the bottom, right, and you just need that 10K, five, sometimes even just 5K, I guess there's no amount that is too small. But what you need is just to hire a software engineer that would build an MVP for you to show the traction, or to show the early progress you need. So whatever you need to fundraise from, to communicate and tell a better story, uh, even to grant investors, people that give grants. I guess we don't have a lot of it now that there's no USAID and all of that, but there's still some around that will give you funding. Again, I mentioned earlier about storytelling. It's a skill that most founders and generally most people miss and don't have. If you're a good and effective storyteller, you are better positioned to convince someone else to give you money for a future you're promising them. Ultimately, it's all a vision. It's all about the vision you're painting. If you paint a significantly promising vision for someone, and it's convincing enough, and it's realistic, it's practical, and there are steps you've provided that will help you get there. All things considered, again, it will take some time because that is life. Um, but you'll probably get what you need at least to show that initial progress. Then, in the absence of all of that, your personal network. You may not know an angel investor that will give 50K, but you may know a friend from your high school or from your university that can give you 5K, that can give you 10K if you go back to them, 4 years after you graduated, and you can say, hey, this is just wonderful thing I'm building. So I guess hustling, I guess that's the bottom line of it all.
Okay, sorry, we can't take too many more questions, right?
Again, no one should have a business negotiating equity straight up if they haven't delivered value. So if they deliver value, you can give them, you can promise or sign a contract to give them a percentage, part of the next safe, the sources of the fundraising. They can get a piece of that if they've delivered value. Um, but again, before you start asking all other people for value, as I mentioned earlier, also you deliver value, do something for them, and they'll be able to put in a good word for you.
I just want to make a quick point around like access, and what you mentioned is the way these things work is what we are doing here is building. In 5 years, this is going to be the next inner circle, right? The inner circle that we currently reference started from people just coming together, talking and stuff like that. And I interest me to know that when I talk to some founders that are even big, they kind of look down on people that are not partner level in the fund. But like if we look and tell you like to what degree analyst, associate, and those people actually have like the power to make or mar a deal, right? If you make a case against a deal, like there's very little room where it's going. So it's a case of there is no network that is lost. Like TechPoint is creating a platform where folks can connect. If you connect with Olumide and you actually have a business that fits the TLCom mandate, this is your one man in already. This is the new inner circle, right? It reminds me of a lot of things. Like there is this guy online. He just started like posting. He started posting like tech things, and I was like, oh, tech, and okay, this may be another TikTok guy or something. But currently, I think Ayobami is doing like really great stuff. Abayomi or what his name is, right? So there is something about social capital, like Dr. Aproko Doctor rather, is trying to build a startup now. If Aproko Doctor comes to me to say he wants to, he's building an health tech startup. I mean, the conversation is not a ground zero conversation. It does not matter if he's the best doctor. If another doctor comes to me, because the proxy in my mind is like this guy has like social capital, right? It's easy for him to his chances of success are much higher than an unknown person. It's like don't think of it as there is a circle that has been drawn and you're out. You literally, and with the examples I've given you, literally can draw a circle around yourself. It's like you can build value by just talking about what you do, like people say they are founders and they stop talking about what they do. It's no longer I don't want to. It's don't stay in my stays and stuff like that. It's like you need to keep talking about what you do over and over again. The best seed stage founders that we have in the ecosystem are people who are, for lack of better word, quote and unquote, nuisance on the tier with what they do. Like every single thing they do, they plug it in, and you realize that they make like we see these things online. You cannot tell me you want to start a startup. I go on your Twitter or this thing like there is no mention of it. Maybe are you ashamed of your startup? You're ashamed of your startup. I want me to give you money, right? It's in the things you put like it's in the. I don't think there is anything like Circle in the African tech ecosystem. The most people that you need to actually build connection with. If I was starting a fund today, if I was starting a startup today, Olumide, I mean, I know him. We happen to have gone to the same postgraduate uni and stuff like that. But by virtue of just knowing them from events like this, and they are even more accessible than the partners, is I've made a case for a startup that was my friend in the uni, but the startup was good, right? So don't get me wrong, the startup was good, but I saw it and I went to the partners and I was like, we really should invest in this. And we ended up investing like close to 500K in that startup. So there is the thing you said about your one connection away from the inner circle. In fact, there's nothing like inner circle. Very soon in the next 5 years, like Olumide is going to become a partner. I don't think I'll be in VC for that long, but but like if I need to like raise a big round, just like Olumide, look at this thing now. It's not I'll give him rubbish. He's going to tell me, my guy, I like you, but I can't invest. But provided I have something that makes sense, and I give it to him, like it's going to look at it. So connections with analysts, connections with folks in the room, and just building value in yourself. Like we're in a case where there's a time when they say build it and it will come. We have now entered a scenario where it's even in your personal brand, your personal stuff actually pushes the business a lot. Sheye is always talking about paid. Dr. Necto is always talking about well out. Tosin is always talking about ladder, right? I've not invested in these people, I don't know. But then every single time you go, they find a way to plug what they're doing. Sam Altman raised $40 billion. He's always talking about, oh, I can't sleep tonight because of the chat GPT. I want to launch this Ghibli and stuff like that. So are you a subject, just think about it like this. Are you a subject matter expert in the field you want to actually build a startup? When I was consulting for 54 Collective, one of the things we looked at, we'll tell you all of it should come idea stage. But it's not true. Like if you're not a subject matter expert in that thing, we are not going to invest in. And how do I know who a subject matter expert is? I don't. It's the truth. It's their proxies. So these things, it's like, oh, this person talks a lot about health, TikTok, 1 million followers and stuff like that. It's the reason why someone like Kim Kardashian will raise like or Rihanna will raise a lot of money for whatever consumer product she wants to do. Is she the best consumer strategy or stuff like that? Like there are different kinds of capitals in the world right now. Like if you're a Docneto or a Aproco doctor, what you were doing was just sharing L tips. Now you launch a startup. What Tosin was doing was sharing financial education. Now she has gone full on into this, and then they were quite a license and start doing all this big big tech stuff. So it starts with you first. You are the first startup that you need to build before you like push a startup out there. And then it makes conversation easy. There are people I meet and I'm like, oh, I've seen you on the TL. And then it makes conversation easy. I'm an analyst, and then these are the where again, analysts, we don't have too work done to look out who will be the next breakout. So we're always on the TL, we're always reading LinkedIn, we're even chatting with ourselves, guy, I beg, have you seen anybody? Like that's how crazy it is because we also, like you said, we have targets. So and then your career growth is even tied to how many good deals you can do, right? So we're looking for everything that there's nothing you are building. If you are building in agriculture, there's some guy, Niger farmer online or something, Samson Obole, right? The soilless guy. There is no topic that you want to build in if you build yourself into like a subject matter expert and people know, it makes conversation easy. It like short circuit a lot of things. So I would give the advice around the fact that don't think about it as external inner circle versus, because that thing has really stopped a lot in terms of the fact that if I kept thinking like that, I didn't study finance. I studied mass communication, and I'm in VC. It started with a cold email to an analyst that worked within the fund I wanted to get into. So really, it's democratized as it is, but the most important opportunity is not that you can reach out to someone, is that you can become someone. Like that Abayami guy, his followers are now really crazy. He's running like different pitch this thing. Before you know it now, is Benjamin Dada was a blogger, right? And then now he's like one is if you say, oh, what are the legacy media in tech? Adewale was a photographer, started blogging about tech. Now TechPoint is this big thing. So you yourself, you're a startup, you're a platform, you can literally become that inner circle and build your own network with. Talk to me, talk to him. We are both analysts. We know people, all right? We can introduce, provided that what you have actually fits their mandates. That's how things happen. It really happens over like, and this inner circle you talk about is just really about, oh, they're talking about beer, and then, oh, this guy, look at it. If he really doesn't fit, they won't push it forward, right? There are cases where of course, everybody has like that moment of there are errors in judgment and stuff, but directionally, right? That's the way it works. So I really do hope that a lot of people that have startups here start to think of themselves as startups, build a lot of value around what they do, become subject matter experts. It makes the conversation easier. Connect with, don't look to connect to Olumide and all those people. It may look a little pushy, and that's what I've seen. A lot of times I go out with my boss, and it's the person that spoke to me. My boss literally hears like over 1,000 pitches, like, and then they're like, "Oh, how will I talk to the analyst?" And if you build a relationship, we will fight for you tooth and nail because we want to be seen as bringing a deal that makes sense. But most people they don't see it. They just see it as top conversation. There are those situations, but directionally, it's really not. I wish people could see what goes on behind. Most of these partners, we just give them things to read out, right? It's not, oh, sorry, please. Yeah, it's like you make a case for the deal, and of course, with their experience, they know, they are great folk, right? But connect with people that you are accessible. Anybody within the fund that's in the investment team has a voice, like all things being equal.
All right. So unfortunately, we can't take any more questions. Sorry, you have to meet them backstage in order to ask your questions, or you're on social media, LinkedIn, Twitter. You can send him a DM, right, and he'll give you a response. So thank you so much, Ayobami and Tolumi.